Yeah, what's up, everyone? Welcome to another session of PJCF's Academy Training. So, this is an advanced concept, and we're looking at the weekly range and daily range. So, making use of the ICT power of three concepts, we'll be looking at the accumulation, manipulation, and distribution um, in the market. So, generally, one thing we know about the market is that um, the market has this thing this manipulation, the power of three concept is repetitive in the market. So understanding of it is how we actually form a daily bias and also a weekly bias, because the market doesn't just, if the market is going up, for instance, okay, yeah, a market, in a bullish market, we don't just get something like this in a bullish market. You understand? Market won't just go up like this in a bullish market. So we have the series of higher highs, higher lows, and you understand? So and on like that. So, but the one we are looking at today is how you can make use of the power of three concept to take day trades. You understand? So you can also use this for swing trades as well. So we'll look at that also. But for this video, I'll be looking at the daily range alone. So generally, I say we have an ideal profile for a bearish market and a bullish market. Now, and we're looking at accumulation, manipulation, distribution of this expansion of this profile. Now, one thing we need to know is that in a bearish day, price will open first. Okay, let's look at this. Let's make a pictorial view of it. Okay, so I will have it. Let's look at bearish and bullish. So I'll make the video short. So in the bearish day, for instance, that means market has been coming down. So what do you want to expect? We expect the next bearish candle that would form. This is the next bearish candle. The candle would open first. Okay, you know what? Let's use this, yeah. The candle opens here. So we have the open price here. So after the market opens at this price, what happens? After market opens, this is a bearish candle now. You understand? We're looking at this as a bearish candle now. The market opens here. Probably you've been hearing something like high of the day, low of the day. Everything. So this is what the market does on a daily time frame. The market in a bearish condition, market will open here. After the market opens, the market has and creates this high. Now this high that we're looking at now. So we'll look at the high of the day. So look at this. This is the close of the day. And then look at the low of the day. Now, now in an ideal bearish day, this is what happens. The market first opens at this price. After market opens, then probably at this level, market is accumulating. Then market manipulates. Do you understand? So this manipulation now, there are two reasons why the market manipulates. Reason is that for in the bearish day now, market induces traders to start buying, because after the market opens at this price and the market starts going up, there are some traders that they have this FOMO, that's FOMO, fear of missing out. So the basic reason why traders and why market does this move is to trap traders. It wants to trap the early the FOMO traders, because there are some traders that immediately they say market is going up, they start buying also, thinking that that will be the daily direction of the market. And after they start buying, they'll just notice that market will just reverse on them. You understand? As market is reversing on them, market is taking money from the bulls, it's claiming them out. You understand? So now the ideal direction for the day is a bearish direction. Market to expect market to go down. But after the market opens, it starts going up, whereas we're expecting to go down. So as market starts going up, some traders will start getting in on buy. They'll start buying, they'll start buying, they'll start buying, they'll start buying, and the market will just reverse on them. Do you understand? Whereas the other reason, this is one. So this is what to trap traders. Do you understand? To trap traders, that's one reason why the market creates this manipulation. So this manipulation move is what we call Judas swing. This manipulative move is what we call Judas swing. You understand? So market creates this Judas swing, and then this is what we call the manipulation, the move that trips traders to start buying, whereas the market is still going down. So that move is what we call Judas swing, and the market distributes lower. You know, I said we are making use of the ICT power of three concept, which is the accumulation, manipulation, and distribution. Now, what has happened here? Market has accumulated around here. So we have the accumulation here at the open. The market distributes and manipulates rather. After the manipulation, the market distributes to be accumulate again. So this cycle goes on and on in the market. So how do you now get to know why market does this? I said one already, to trap traders and also to trap sellers. Now we know that market has been selling right from this point. You can see the market is in the bearish direction already. So you want to get into that bearish direction also. Now, why? How do you get that in? How do you get in? And why does the market? You know, there will be some sellers here now. For instance, now some people are selling at this point. So this is how the market takes. Okay, not this. Now we have sellers around here selling already. So let's assume now this is a new day and market is doing this, accumulating. Let's take it that this was a previous day. Now this is a new day and the market starts accumulating. That's the first thing that we see in a power of three. The market starts accumulating. So you can see the accumulation here. So after the market accumulates, like I said, the market does this move, this manipulative move to take out early, to take out FOMO traders, because immediately market starts going up like this, you can start having the markets coming up like this. Yeah, let's say the market comes up above this point, and you know there are some traders that they are breakout traders. Immediately that they see market breaking out of this high, they will start buying. You understand? They'll start buying, thinking market is continue going higher. And immediately what will happen? Market will just reverse on them and continue going lower. So what has happened here is that these traders that bought early, that took the breakout, that's the traders that they do not want to miss out on the move. The FOMO traders, fear of missing out. You get, they will enter A and the market will take out their, and also the sellers, also the previous day seller, you know, someone that is selling from this point will be securing his or her profit, and we want to move his or her stop loss to a protective and a structural level, for instance, here. So what has happened here now? Someone placed his or her stop above this level. And see what has happened now. Market took out that stop and then reversed on him or on the seller. Whereas the direction of the seller is right. But what has happened here is the market has actually taken or neutralized liquidity. Because right here there's money here. There are people stops around here. You understand? So market has gone there to neutralize those sellers and then continued in its own direction. Do you understand? Because now markets want to sell. This is just the psychology behind it. Markets want to sell because you should know that if the market is in a bearish direction, you should have what? Buyers. If you want to sell, then there should be a buyer that wants to buy from you, isn't it? So now, anybody taking a sell will put his or her stop loss above here. That stop loss is a reverse order, because if you are selling and you put a stop loss, the stop loss is your buy, because that's how market works. I think we all understand that. So now there are buy orders here, which is a stop loss in the form of stop loss here. Market will move to that point of buy orders and then start selling, because it wants to sell and then it needs to go to a area of what? Liquidity, which is what has happened here. You understand? So this is how an ideal bearish profile, daily profile looks like. You understand? So the market creates this Judas swing. So this move that goes high to this high is what we call the Judas swing move. Do you understand? So, and one of the things at the time that this move happens, one thing you should note about is that this move happens during the London session open. So, okay, this is the Asian range. So during the London session open, we can have this move here. So let's note it. London open or New York open. That's the time that we have this move. So I believe you understand. So the same and the opposite goes for the bullish pattern as well, because in a daily range also for a bullish profile, what do we expect to see in a bullish profile as well? So we're looking at seeing something like this. Market is creating higher highs from the previous day. So move into a new day. So what do we see in the market also? The market starts accumulating. Starts accumulating. So that's what we have the Asian range. And then the market is buying because a bullish market and we still want to buy. So what happens? This low, this is also a protective structure where people are putting their stop, because at this level now, market is already buying. So market has created this higher high. We all know that higher high, higher low concept now. So they will put their stop loss at this kind of structure level below that point. And what happens? We expect the market to continue going higher, isn't it? As a base, but you know what the market does? The market will just break down and start going lower. So the early traders, they will think that market is already going down. I don't think market wants to come up. And what will they do? They will start selling. And what happens? The market just comes to this level, take out, clear out liquidity, and will reverse immediately on them. Do you understand? So right here also, what do we have also? We still have market taking our liquidity. And at the same time also, we have the early traders that are getting trapped, because they'll start selling immediately the market breaks this ranging market. They'll start selling, whereas market has its own intention in mind. And see what has happened. Market has what accumulated. This is accumulation, this is the manipulation, and then this is the expansion. So this is somewhat it's kind of similar to the IPDA. You know, in IPDA now we have IPDA, that's the interbank price delivery algorithm. In the interbank price delivery algorithm, that's where we have. Okay, let me see if I can get that. So in the IPDA, we have the contraction, we have the expansion, we have the retracement, and then reversal. So now contraction is what has happened here. We have the expansion, market expanding to this point. Then we have the retracement and then whatever the reversal. So in an ideal market, this IPD is somewhat similar to this. I just have to just put that in, but then the IPD also is more like the this is how okay, this is not the course of this content. So we'll look at that in another lecture. So this is just the basic daily range of a bearish profile and also a bullish profile. You understand? So this is a bullish profile. So what do you expect in a bullish market? What happens? In the same way we have this also. In a bullish market, what is going to happen, and things we expect to happen in a bullish market is that the market opens lower. You understand? It opens lower. You understand? The market opens lower here. So you can see in a bullish market, like the bullish profile now, market opens lower at this open price, and after the market opens there, what we expect is that market opening at this price, the market manipulating to create the low of the day. See, the manipulation is lower here. So this is the Judas swing lower here. So in this point, the market is trying to take liquidity or trap traders, and then what happened? We have the distribution. Do you understand? So that's what happens, and that's just an ideal daily profile. So we can now go to our chart now and see what that looks like. So let's look at Euro card for instance now. Yeah, Euro card. Now looking at this Euro card now in a bearish profile. So let's look at this previous separator. Now the market is bearish, isn't it? You can see the market being bearish here. We have a bearish market here. Then after the market distributes lower, you can see now this is a bearish market. Then what do we see now? We expect the market to continue going lower, isn't it? But see what happened after the Asian session, market was looking like it was going up. So meaning some traders will be thinking market will just continue going up. What would they do? They'll start buying. And see what has happened. Market looked at the see this structure point. Any other trader would have put their stop loss around this area, or anybody that is selling from this point to want to move their stop loss around this area or this area. And see what has happened there. Market cleared that stop loss, cleared that area, and see what happened. It's dropped very well. Do you understand? So the same thing has happened around here too. These are the levels, these are the structure point, because now this is the lowest low for the previous day. This is a structure point here, meaning anyone who wants to put that stop loss. You see, I have my level there. Anyone wants to put that stop loss above this point. Now, during the Asian main, now the Asian session, you see, market has taken out that liquidity at this point, and then see what happened again. We still had the continuation to the downside. So let's look at this again. So in this day now, you can see that this is the structure point that we had. These are the structure points here, not this one. I won't take this one as a structure point. So we had the structure point, and market did not visit there. So for that day, probably if you are using power of three, you might not have a trade, isn't it? So the same thing on and on and on like that. The market keeps on repeating this and painting that structure for us. And you can see, look at this again. Let's make use of this example too. Let's look at this day. Look at this day. Look at this day. Market is bearish. You can see a bearish movement. So these are the structure points also. These are the structure points. You can see this is a structure point, because anyone would want to, any logical person that's selling from here will want to put their stop loss around this eye to protect it. You can see market is just kind of having a complex pullback and everything, but then anyone wants to put their stop loss above this point to protect, and see what has happened. Market cleared that, and after clearing it, see what happened. Market went down. So the time that market is doing this, look at this time now. This is during the London Open. So immediately London market open, see what happened. We are having the distribution. So it can happen during London Open or during New York Open. So this also happened. You can see. Look at the time down here. Look at it down. You see, it's also during the London Open. This one happened during London Open. So what about this? The same thing happened during London Open, the start of the distribution or expansion. And then we have some that I think are in. There are some here that has the New York Open. Yeah. So you can just backtest this strategy, this concept, and then you just be amazed at how well and how sweet it is for you to trade. So thank you.